most people hear health savings account, they think of a simple account to help pay for doctor's visits, prescriptions, and other medical expenses. And while that's true, it's only part of the story. For the right person, an HSA can be one of the most tax efficient accounts available. In fact, many financial professionals refer to it as offering the triple tax advantage. It's a combination of tax benefits that's difficult to find anywhere else. But here's the catch. Not everyone qualifies. The rules matter. And how you use the HSA can make a significant difference in both your tax savings and your long-term financial plan. Today, I'll explain why the HSA is much more than a medical spending account, who should pay attention to it, and a few common mistakes that could cost you. Hello, I'm Lisa Marie Odeja, CPA, EA, former federal government auditor, and advanced tax strategist at Pinnacle Financial Services, where we help real estate investors and profitable business owners legally reduce taxes and build wealth through advanced, defensible tax strategies. Now, before we begin, remember that this video is for educational purposes only. Every taxpayer's situation is different, so be sure to consult your tax advisor before implementing any strategy. So, what makes an HSA so special? Most tax strategies give you one tax benefit, but the HSA has the potential to provide three. First, eligible contributions may reduce your taxable income. Second, the money inside the account can grow without current federal income tax. And third, when the money is used for qualified medical expenses, those withdrawals are generally tax-free. That's why it's often called the triple tax advantage. Very few accounts offer all three benefits together. Now, let's discuss who can use one. This is where many people get confused. You don't qualify for an HSA simply because you have medical expenses. Generally, you must be covered by an HSA eligible health plan and meet several IRS requirements. One mistake I see is people assuming that every high deductible health plan automatically qualifies, and that's not always the case. So, before contributing, make sure your specific health plan is actually HSA compatible. It's a small step that can prevent much bigger problems later. Now I'll discuss why I like HSAs from a tax planning perspective. Many people think an HSA is simply a checking account for medical bills. Now, it can certainly be used that way, but for some taxpayers, it can become much more than that. Because unused funds generally remain in the account from year to year, some people choose to leave the amount invested rather than spending it immediately. And over time, that balance may continue growing while remaining in a tax-advantaged environment. However, whether that makes sense depends entirely on your financial situation, your healthcare needs, and your overall tax strategy. That's why there's rarely a one-size-fits-all answer. Don't forget the contribution limits. Every year, the IRS establishes limits on how much can be contributed. So for 2026, the limits are $4,400 for self-only coverage and $8,750 for family coverage, with an additional catch-up contribution generally available for eligible individuals age 55 and older. But here's something many taxpayers overlook. Employer contributions count towards those annual limits. So if your employer contributes to your HSA, you cannot simply add the full annual maximum on top of that. Understanding how those contributions work can help you avoid excess contribution issues. Here's something many people don't realize. Some taxpayers who can comfortably pay for their current medical expenses out of pocket choose to leave their HSA funds invested instead. And that allows the account to potentially continue growing while preserving those tax advantages. Now, whether that strategy makes sense depends on many factors, including your cash flow, investment objectives, expected medical expenses, and your overall financial plan. It's a good example of why tax planning simply isn't about knowing the rules. As I always say, it's about understanding how those rules fit into your specific situation. The Medicare surprise. Medicare is another area that catches people off guard. Once you're enrolled in Medicare, your ability to continue making HSA contributions changes. I've seen taxpayers who didn't realize that timing mattered. It's one of those details that's easy to overlook until it becomes a problem. So, fortunately, it's also something that can often be planned for in advance. So, is an HSA right for everyone? Not necessarily. The tax benefits are certainly attractive, but choosing the right health plan should never be based only on the tax deduction. You should also consider deductibles, premiums, provider networks, expected medical expenses, prescription costs, and your overall financial situation. Sometimes the best tax strategy is not the best overall financial decision. That's why I encourage clients to look at the entire picture instead of focusing on only one benefit. One of the things I enjoy most about tax planning is helping clients understand how different strategies work together. An HSA doesn't exist in a vacuum. It may affect your retirement planning, your investment strategy, your cash flow, and your overall tax picture. And when those pieces are coordinated thoughtfully, the results can be much more meaningful than looking at each decision separately. That's why personalized planning can make a real difference. So, to summarize, the HSA or health savings account is much more than a way to pay your medical bills. For eligible taxpayers, it could be one of the most tax-efficient accounts available. But like most tax strategies, the value isn't simply knowing that the account exists. The real value comes from understanding whether it fits into your particular situation and how it's coordinated with the rest of your financial plan. If you're a real estate investor or a profitable business owner, and today's discussion about HSAs made you wonder what other tax saving opportunities may be available to help reduce your tax liability, now may be a good time to review your options before the end of the year, while many tax planning opportunities are still available. I'd love to help. Simply schedule a discovery call with Pinnacle Financial Services using the link below or scan the QR code on your screen. And during our call, we'll discuss your goals, your concerns, and determine whether we're a good fit to work together, and I'll explain how our firm works. If we both decide it makes sense to move forward, we'll discuss the next steps. If this video helped you, would you do me a favor? Please like it, comment, subscribe to the channel, and share it with someone you think could benefit. My goal is to reach as many taxpayers as possible before tax season because many tax savings opportunities need to be put in place before the end of the year. Every tax season, I meet people who come to me after the year has already ended. And it's frustrating because many of them may have benefited from significant tax savings if we had just had the opportunity to plan together earlier. That's one of the reasons I make these videos. If sharing this video helps even one person, discover those opportunities while there's still time to act, then it's absolutely worth it. Thank you for watching, and I'll see you in the next video.